Welcome to my channel. I'm Scott, and in this video we're going to talk about MLPs, Master Limited Partnerships. We're going to first talk about these structures on more of a high level, so I'm going to show you about 5 or 6 PowerPoint slides. Then we'll look at Energy Transfer 10Q and pick apart their financials. Energy Transfer is one of the 60 publicly traded MLPs. The last 2 PowerPoint slides will list all 60 MLPs in case you were curious. Master Limited Partnership, that's what MLP stands for. When 2 or more individuals get together and want to start a company, they may organize a limited partner structure. It's similar to an LLC. So say you and your friend wanted to start a business, so you organize an LP structure. Each of you puts 50% of the funds in. You put in $50,000, he puts in $50,000, and you start your business. The nice things about these structures is you can only lose up to the money you put in. There's limited liability. So you couldn't get sued for like millions of dollars if something happened. An MLP is an LP, but it's publicly traded. The reason some companies organize as an MLP is so they pay less taxes. Usually 80% to 90% of their profits are tax deferred. So an MLP combines the tax advantages of a private partnership with a stock's liquidity. Because as you know, a stock is a lot more liquid than a private business. In order to be eligible to structure a business as an MLP, you have to be US domiciled, and you must receive at least 90% of your revenue from natural resources or real estate. That's why you see a lot of oil and gas MLPs out there. Because if you manufacture something, say furniture or electronics, you can't organize as an MLP. If you're like me and you own stock in an MLP, you're an LP, limited partner. All shareholders are LPs. There's also something called a GP, general partner. They usually own a small percentage of the MLP structure, and they also manage it. So they run the day-to-day business. MLPs issue units, not shares. So you're actually a unit holder, not a shareholder or stockholder. That's why when you look on their balance sheet, there's no stockholders' equity. There's something that's called partners' capital. But people still use the term stockholder when they talk about MLPs because it's such a common term. But if you want to get technical, you're actually a unit holder. Depreciation and depletion pass through to the unit holders who can use those deductions to reduce their taxable income. Depreciation is spreading the cost of a fixed asset over several years onto the income statement. So let's just say you purchased a van for your business and the van costs $100,000, and you estimate the van will last about 10 years. So each year you put $10,000 onto your income statement for the next 10 years. That's called accrual accounting. You want to reflect the actual expenses in the year they occurred. Because say in 2022 you bought the van, you don't want to put a $100,000 expense on your income statement. It may look like you had a huge loss in 2022. Pretty much all public companies use accrual accounting, but if you own a small business, you probably use cash accounting. It's much easier. A lot of people don't know what depletion is. It's the amount of natural resource that's removed from its source, like oil from the ground. It's different than depreciation, but it has the same concept. Let's say you paid $100 million for the rights to a location to extract oil. Say you extracted $10 million of oil each year for 10 years. You would have to put a $10 million expense onto your income statement. But let's just say, for example, in year 1, you extracted $50 million of oil. You'd put a $50 million expense onto your income statement. That's depletion. You have to reflect the amount that you pull from that natural resource. It may not be smooth like with the van, because one year you may extract more oil than another year. If you hold an MLP in a retirement account, and you receive more than $1,000 of dividends, that's considered unrelated business taxable income, or UBTI. And UBTI is subject to immediate taxation. Most investments in a retirement account are tax deferred. You don't pay any taxes until you retire, until you take the money out. So it's usually a good idea to hold MLPs in a taxable regular account, not a retirement account. But there's nothing wrong holding it in a retirement account as long as you understand this. Because remember, when you hold units of an MLP, you're a partner, you're not a stockholder. Now let's talk about taxes and dividends. So if you receive ordinary dividends, that means you held the stock for less than 60 days. You have to pay the higher tax rate, 10% to 37%, depending on your income. So if you don't have a job, you don't make any money, and you receive those dividends, you only pay 10% tax on it. But if you make a lot of money, you might pay up to 37% tax on it. Qualified dividends is when you receive a dividend and you held the stock for at least 60 days. Qualified dividends are taxed at the long-term capital gains rate, which is 0% to 20% depending on your income level. But pretty much all dividends on REITs, MLPs, and BDCs are taxed as ordinary dividends. The reason most dividends are taxed at the higher rate is because these entities avoid double taxation. They don't have to pay tax and then give you a dividend where you pay tax on the dividend. They pass through most of their profits to you, and then you pay tax on that. So you do get a higher dividend from an MLP than a regular stock, but you pay a higher tax rate. So you have to look at that to see after taxes if you're actually getting more money. The limited partners or the unit holders, you see I put shareholders because I'm just so used to that term, they have to report their dividends on their personal tax returns. And ordinary dividends from any stock must be filed on a 1099 div. But the nuance with MLPs is that distributions must be filed on a Form K1, which your accountant should understand what this is. There are 60 publicly traded MLPs. All of them trade in the US because you have to be a US domiciled company to be an MLP. The largest company is Enterprise Products, 53 billion market cap, 8% dividend yield. I pulled this list from a website, so I'm not 100% sure these numbers are up to date, but they should be pretty close. Lots of trading volume, 5.7 million shares a day. The most liquid is Shell Midstream. You see lots of oil and gas midstreams on this list. Energy Transfer, one of my favorite stocks. I own Energy Transfer. That's one of the few stocks that's up this year for me. I think I'm up like 50-60%. That's not including the dividend. And this is the second half of the list of the MLPs. The reason Blue Knight is 0 is because they were recently acquired, so the stock ticker went away. Now let's dig through Energy Transfer's 10Q. This is Energy Transfer's latest 10Q. Energy Transfer is an oil and gas midstream MLP. This 10Q is as of September 30th, 2022. And if you go to the second page, it's a table of contents, so you can jump between sections. I like to look at the financials. Here's a link to the balance sheet, the income statement, statement of cash flows, and some other reports. We can also go to the MD&A, Management Discussion and Analysis. Let's click on that link. And this gives us some high level on what's occurred at the company. So any big acquisitions, you're not going to see every single acquisition, but the big ones they're definitely going to show. They acquired Woodford Express, and this acquisition was nearly $500 million. And this is a scoop play, the South Central Oklahoma oil province. ET owns all the Sunoco gas stations in the US. So their subsidiary Sunoco made an acquisition for $252 million. In 2012, ET acquired Sunoco, the 5,500 US Sunoco gas stations. Let's go back to the table of contents. Now let's click the link to the balance sheet. We'll go through their financials. They cannot fit their balance sheet on one page. So this is the assets, 105 billion. Then the next page is liabilities and equity. So assets have to equal liabilities plus equity. They don't keep much cash on their balance sheet, only 326 million. So if we have $326 million, that's a ton of money, but to them it's a rounding error. 8.6 billion of accounts receivables. This is how much money other companies owe them. 2.5 billion of inventory. They have a little over 12 billion of current assets. Current assets are assets that can be converted to cash within 12 months. Most of their assets are non-current. They have over 100 billion of PP&E, property, plant, and equipment. And most of that is probably their oil and gas pipeline infrastructure. Also, this is the 5,500 gas stations that they own, because I'm sure there's lots of fixed assets at each location. And they've depreciated 25 billion, so the book value is 80 billion. So about 80% of their assets are PP&E. They have 5.5 billion of intangibles. This could be patents or trademarks. 2.5 billion of goodwill. Goodwill is the premium you pay when you acquire another company. So this 105.7 billion will match the next page. So here's their liabilities and their equity, 105 billion when you sum them up. Current liabilities is what's owed within the next 12 months. So 7.5 billion of accounts payable, this is what they owe other companies. 3.6 billion of accrued liabilities. Accrued means it's been incurred. So when a company incurs an expense, but it hasn't paid it yet. Let me give you a simple example of accounts payable. Say you went to a store, bought a couch that cost $2,000, and they gave you credit. So you pay the $2,000 over the next 6 months, no interest. But if 6 months passes, then you pay a 10% annual interest rate. So that's accounts payable. You receive something and you owe money on it. Let me give you a simple example of accrued liabilities. Say for example, ET pays their employees on the 1st of each month. Payroll is monthly. Let's pretend their payroll is $1 million a month. If you looked on their balance sheet in the middle of December, they accrued $500,000 of payroll. They don't owe their employees anything until the 1st, but they're accruing those expenses each day. And on the 1st of the month, they'll have $1 million of accrued liabilities for payroll. And once they pay their employees, they take that $1 million off their balance sheet and book it as an expense onto their income statement. Long-term debt is the bulk of their liabilities, $47 billion. This is debt that's owed beyond 12 months. Let's just search this dollar amount. So here's a breakdown of that 47 billion. 37 billion is notes and debentures. 2.6 billion in a 5-year credit facility. If they own more than 50% of their subsidiaries, they have to report the debt those subsidiaries owe. Sunoco owes 2.7 billion. Let's go back to the balance sheet. In their equity section, they have no stockholders' equity. It's called partners' capital. Preferred unit holders have 6 billion of equity. Common have 27 billion of equity. Total partners' capital is 33 billion. 7.7 billion of non-controlling interests. So if another company owns between 10% and 50% of ET has to report that company's ownership as non-controlling interest. I'll show you in the statement of cash flows later that the entity that's a non-controlling interest receives a really big dividend. Let's scroll down to the income statement. They call it the statement of operations. And this shows us the third quarter of 2021 and 2022, the first 3 quarters of 2021 and 2022. So in the first 3 quarters, they had 20 billion of refined product sales, up from 12.7 billion. They may have sold the same volume of refined products, or maybe even less volume in 2022. But if the price of oil went up a lot, then their revenue goes up a lot. Refining oil is turning oil into something useful, like gasoline or jet fuel. Because when they sell crude from the ground, it can't be used for anything. You have to refine the crude. You can't just pull oil from the ground and put it into your car. There's an expensive, long process to turn it into gasoline. Natural gas liquid sales, 16 billion. That's also up a lot. Gathering, transportation, and other fees, that's part of the midstream process. Natural gas sales, 6.8 billion. So this company does a lot of midstream and downstream activities. Upstream is the beginning part of the oil and production process. It's actually extracting the oil from the ground, or whatever location you're extracting it from. That's the riskiest part of the process. You could also make the most money in that part. But midstream companies are the safest, because they mostly work on contracts. So the price of oil doesn't affect them nearly as much as an upstream company. Because midstream companies store, transfer, market the oil. And then downstream companies, which they do some downstream, refine the product. So when you pump the gas into your car, you're as far downstream as you can get. That's the last part of the process. But you may hear the terms upstream, midstream, and downstream with other businesses. A cannabis upstream company is actually growing the plants. A cannabis downstream company is in a retail store selling it to the end user. In order to generate this $69 billion of revenue, it cost them $63 billion. So their margins are not that big because there's a lot less risk for midstream companies. They pretty much guaranteed a certain return. So in the third quarter, their income before taxes is $1.4 billion, and they paid $82 million in taxes. That's only a 6% tax rate. That's why companies become MLPs, so they pay such little in taxes, and there's more money that flows to you, the investor. And there's some MLPs that pay no taxes, but obviously not 100% of this company's revenue is tax deductible. So their net income for the first 3 quarters of 2022 is $4.4 billion, which is down from 2021 of $5.5 billion, even though they had more revenue. So the earnings per share is down from 161 to 106. Now let's look at the statement of cash flows. And at the very top of the statement of cash flows, you'll see this $4.4 billion. The first section on the statement of cash flows is cash flow from operations. And CFO converts net income into cash. Their accounting profit is $4.4 billion, but they generated $7.7 billion of cash flow. And the main reason is depreciation. Remember, they had $100 billion of fixed assets on their balance sheet. They have to depreciate those dollar amounts. And depreciation is a non-cash expense that brings down your net income, so we add it back here. Depreciation is up. It was $2.8 billion in 2021, now it's $3.1 billion. So it looks like they added fixed assets. And you could see in the cash flow from investing section how much they spent in fixed assets, capital expenditures. It's up from $2 billion to $2.5 billion, which is a pretty big jump, about 25%. They also spent over $1 billion in acquisitions, so they had a cash outflow of $3 billion in their investing section. In their financing section, we see the debt and equity changes and also dividends. So they are paying down debt. Last year they issued $12 billion of debt, paid down $18 billion. This year they issued $19 billion, paid down $21 billion. Because MLPs and REITs have to take on debt to grow. Because a company like Google can have $30 billion of profits in a quarter and keep all that $30 billion to grow the business. This company cannot do that. They have to give at least 90% of their profits back to the investor as a dividend. In the first 3 quarters of 2022, the dividend is $2.1 billion, up from $1.4 billion. And you could see the non-controlling interest got $1.2 billion of revenue. All the other individual shareholders, one of those is me, got part of this $2.1 billion. So I hope you learned something new in this video. Please comment, subscribe, give me a like. Talk to you soon.